If you're trading without a backtested system, then you're gambling, whether you realize it or not. But if you're like most traders, then you've got a ton of unanswered questions about backtesting and trading system development that are holding you back. In this video, I'm going to answer all of them so that you can move forward with confidence. My name's Adrian Reed and I'm the founder of Enlightened Stock Trading, and I've been a profitable systematic trader for over 20 years. I actually left the corporate world in 2012 to trade full-time. I traded just at home on my own since then. But after I left the corporate world, it took me only a couple of years before I was sitting at home bored, lonely, and depressed because I didn't have anyone to talk to. Yeah, that was pretty sad. It was getting a bit dire, to be honest. My wife said, you've got to get a hobby or you've got to do something because you're driving me bonkers. And so I started talking to traders, and that turned into teaching traders, sharing what I knew. And then that turned into Enlightened Stock Trading and everything that I'm doing today. My trading is 100% automated these days. So I haven't placed a manual trade for several years now, and I must say fully automatic systematic trading has just been life-changing for me. So here's a sneak peek about what I'm going to cover in this video. Firstly, we're going to talk about what backtesting is and why it matters. We're going to talk about the different levels of backtesting and the tools and data that you need to make backtesting effective, and how to turn your backtest into a reliable, high confidence system that you can implement with real money. And then, of course, I'll cover some advanced real-life lessons into backtesting coming from 20-plus years of systematic trading experience. Before we get into the questions, if you're fascinated by the markets, if you love trading and you want to master the art of systematic trading, then hit the like button and subscribe to my channel so you don't miss out on any of my future content to help you level up your trading game. Now, let's get into the questions. The first question is, what is backtesting in trading? And backtesting, I would say, is the most critical skill that you can have if you're going to succeed long-term as a trader. Now, why do I say that? It's because if you don't backtest, you're basically flying completely blind as to whether or not you've got an edge, as to whether or not your strategy is working, whether you're going to make money or you're going to fall into ruin. Backtesting is essentially you take your rules and you apply them to historical market data, and you see when you would have bought, when you would have sold, and you calculate how much money you would have made over time had you followed those rules exactly. And that's really important, exactly, right? Because when we're backtesting, we're assuming that we follow those rules. We buy when they say buy, we sell when they say sell. And so my philosophy, my mantra, if you like, is to test what I trade and trade what I test. So I don't take a trade unless it's based on a proven set of rules that I've backtested and I've built confidence in, so I know that I can follow those rules and I'll be okay. This is probably the most critical thing, because most people, like it or not, don't really know whether you've got an edge that is sustainable long term. Even if you're making money now in the current market conditions and you haven't backtested, do you really know what's going to happen in the next major bear market? Do you know how deep your drawdown could get? Do you know how many losses in a row you might have? Do you know how many down days in a row? Do you know how long between equity highs? These sorts of questions are pretty much impossible to answer unless you've backtested your strategy thoroughly, and backtested in an automated way using software. There's several different levels of backtesting. The first level is where you look at a chart and you say, okay, look, there's a buy. Yep. There's a sell. Okay. Now there's another buy and there's another sell. That's manual backtesting on the chart, where you're lining up your indicators, you're having the buy and sell arrows, and you're looking along and you're recording wins and losses in a manual way. That's the base level. The next level up is testing in a systemized way, where you put your rules into software and you apply those rules to much more market history, 20, 30 years, over thousands of stocks or cryptocurrencies or futures markets, whatever you're trading. And you assemble a portfolio of trades based on that system, and you see how the portfolio would have performed over time. This is the next level. Now that's really critical because it tells you about the drawdown that you would have suffered in the past, because that's the primary driver of whether or not you'll be able to stay in the game. And the number one driver of long-term success, the first and most important thing, is to stay in the game, right? Because if we wipe ourselves out, if we blow up an account, we're out of the game, we can't keep trading. So we really need to backtest to understand are we going to stay in the game? Can I survive long-term trading like this? Does this make sense? Yeah. So backtesting in a systemized way, your set of rules over many decades of market history. The next level above that is combining multiple systems together and testing them together to see how those systems interact. And that's the advanced level where you understand how effective is your diversification. So why is backtesting important? The reason backtesting is important is this. If we don't backtest, we have no clue whether or not our strategy is going to be profitable, whether or not we've got an edge. If we backtest it and it is profitable in the backtest, there's a chance it might make money in the future. However, if we backtest it and it doesn't make money in the past, there is zero chance that it's going to make money in the future long term. So at least if we backtest our strategy correctly, we can eliminate the strategies that just don't work. Yeah, because if it made money in the past, it might make money in the future. If it didn't make money in the past, it's not going to miraculously turn around and start being profitable because you started trading it today, right? It's just not. I've tried. It doesn't work. So we need to first establish, was it profitable in the past? The next leap after that is it really likely to continue being profitable in the future? And this is much more nuanced, and we'll get into some of the detail about how we tell that. But if your strategy survives through bull markets and bear markets, and it keeps grinding up slowly, yeah, it's going to have drawdowns and everything, but if it keeps going up over time and the edge is stable, like it's not decaying and starting to lose money, then there's a good chance it's likely to be profitable in the future. That's really the driver of it. We want to eliminate strategies that just don't work. And you'd be surprised how many strategies from books like this just don't work. Yeah, they might have worked in the past, or maybe they never really worked. But if you find a strategy from a book, from a website, from a course, if you don't test it, you're really flying blind. And I think that's just criminal because it's your money. And no one cares about your money more than you. You've got to take responsibility and check whether or not those strategies work. So that's why I would say backtesting is just so critical. All right. Is backtesting worth doing, or is it just theoretical? Backtesting is absolutely worth doing. A lot of people will say, yeah, but that's on past data and the future is not going to be like the past. So should I really, what's the point? You're just looking at the past. But really, again, the first stage gate, if you like, of being a successful trader is having a strategy that works. If you backtest your strategy and it didn't work, it's not going to work in the future, so you can throw it away. If you backtest your strategy and it did work in the past, you've got a chance. And we need a chance to profit. That's why you need to backtest. There's no point hoping it's profitable. You may as well just check. What are the pitfalls of backtesting that I should avoid? There's obviously a lot of challenges because if it was easy, everyone would do it and everyone would be a profitable trader. We need to understand what are the pitfalls of backtesting. And there's 5 that I wrote down leading into this session, which I wanted to really, I guess, focus on. The first one is blatantly cheating, what I would call future leaks. So writing a system that you can't reproduce in real life. So for example, if you have a system that enters at the open today, but cheats by looking at what the closing price today is, when you buy at the open, you don't know what the close is, right? Because it hasn't happened yet. But if you look in the backtest, in the historical data, you know what the open, high, low, close is in advance because the data's all there. So when you develop a system and you backtest it, the first thing you've got to be careful of is to make sure it's realistic. You've got to be very, really careful to make sure that whenever the backtest is making a decision to buy or sell, that you would know in that moment all the information required for you to place that trade and generate that order. There's a couple of examples that people frequently get wrong when they're developing systems. One of them is that real blatant one is I'm entering at the open today, but the system refers to the close today as part of its calculations. That's a real blunt, kind of dumb one. A more subtle one is you enter at the open today and you have a stop loss that's 5 ATRs wide, 5 times the average true range wide. but you're using today's average true range in your backtest. You can't do that because today at the open, you don't know today's average true range, right? You won't know today's average true range until the close today, but you're entering at the open, placing a stop loss. That means you have to use yesterday's average true range. So you've got to be really careful and think through the process of what would I know at each point in the trade cycle, and make sure that your system rules only refer to things that you would actually realistically know. And you'll be surprised. I get a lot of systems sent to me by people saying, hey, look, I've got this great system. Can you check it out for me and see if there's anything wrong? And inevitably, when it looks amazing, there's always a future leak. It's always cheating by looking forward into the future somehow. And there's so many ways to do it. But just by being aware that you have to check very carefully all the entry conditions, all the exit conditions, and make sure that you're only acting on information you would know at the time, so that when you backtest it, your results are realistic. So the first rule of backtesting really is when you run a backtest and you generate the results and it shows that nice, beautiful equity curve, if it's laser sharp and it looks like you're going to be rich by next week, you've done something wrong. That's the first rule. So it took me a long time, but now I have this automatic alarm bell that goes off. When I produce a backtest and it's this beautiful laser sharp line and it makes anything more than 30 or 40% return per year, immediate alarm bells goes off because there's a mistake in the code, guaranteed. So if you just adopt that, if you take nothing else away from this, if you take that, you have alarm bells when it looks really good and you start to get excited. Oh, I'm excited. There's something wrong. That's going to help because that will prompt you to look into the code, the backtest, and the rules and make sure they're actually realistic. Does that make sense? How many of you have done a backtest and gone, wow, that's amazing. I'm so excited about this system. Anyone? And then found that it was actually, there was a mistake in the code. Yeah. So this is really important. So number one rule of backtesting is have those alarm bells. So we're talking about the pitfalls of backtesting, what you should avoid. Making sure the code is realistic, avoiding future leaks is the first one. The second one is ignoring commissions and slippage. So commissions are actually pretty low now, certainly compared to when I started trading. When I started trading, I was paying $40 to buy and $40 to sell as a minimum commission for stocks in Australia. And at the time, if I wanted to trade US stocks, it was $150 to buy and $150 to sell. It's just crazy town, right? You can't ignore those sorts of commissions. But now, with interactive brokers, you might have a $6 minimum on Australian stocks, a $1 minimum on US stocks. You think, yeah, it's nothing. I don't really need to take that into account, right? Wrong. You do. Because if you ignore slippage and commissions, what happens is these trading systems that have a really fine edge, like a really small average profit per trade, start to look really good. And you optimize it and the equity curve gets sharper and it looks like you're going to make more and more money. And the average profit per trade is like 0.3%. And you think, okay, this system is beautiful, low drawdown, high returns. I'm going to be rich. Again, alarm bells. If you haven't taken into account slippage and commission, when you do, you'll find that the equity curve deteriorates massively, even if it's only a very low commission rate. So my guidance would be when we're doing this sort of work, overestimate the costs in your analysis so that you're pleasantly surprised by what happens in real life, rather than underestimating the costs and getting cut to pieces by commissions and slippage and losing money. How does that feel? Does that feel right? Yeah. So we definitely want to overestimate the commissions. So that means on stocks, if you're trading short to medium term, as in days to weeks, you might be allowing for 0.5% commission for entry and exit. That's going to allow slippage and commission and probably a little bit left over. If you're trading high priced stocks that are quite liquid, it'll be more than enough. But if you're only allowing the minimum, like interactive brokers, what is it, 0.08% commission with a minimum of $1 on US stocks, something like that. If you're only allowing that and you haven't allowed slippage, a little bit extra for slippage, you're probably going to underestimate how much you're going to pay. And that means your equity curve, when you do your backtest, is going to look too good. And if it looks too good, then you're going to position size too high and you're going to use too much leverage. And then when you do those things and something goes wrong and the market turns down, you're overly optimistic, overly aggressive, and you get a much bigger drawdown than what you'll be comfortable with otherwise. Does that all make sense? Okay, so we've covered pitfalls of trading, future leaks, basically systems cheating, ignoring slippage and commissions. Next big one is overfitting past data with too many rules. Yeah? How many rules have you got in your system? 1, 2, 3, 4, 5, 10, 15? If you've got a system right now, how many rules has it got? Now, I have systems that vary from as low as 2 rules to as high as about 15 rules. 15 sounds like a lot. But there's reasons for that. And there's also a lot of history on that system, a lot of trades generated. And so it's very carefully analyzed to make sure that everyone makes a difference. But most of my systems are very simple, thinking 2 to 5 rules. So we don't want to have lots of rules, because the more rules we add, the more we're just overfitting to exactly what happened in the past, and the less likely it is to work on future unseen data, which is always going to be a little bit different to what happened in the past, right? So the fewer rules you have, the simpler it is, the more likely you are to capture the essence of the edge in the market. But the more rules you add, the more likely you are to be capturing the exact nuance of just those stocks and those exact moves in the past, which won't work in real-time trading. And the dead giveaway is when you run a backtest and it looks amazing, and then you start trading in real life and it loses money. That's a sign of the strategy was overfit, too complicated. One exception is if you're adding a liquidity filter. So let's say I only want to trade stocks that have $1 million per day turnover on average. That's required so you filter out the junk, so you don't get a lot of slippage. I'm not so worried about that as a rule. Yeah, it's a rule, but I'm not stressed about that in terms of overfitting past data, because it's there to make the system tradable. I'm more thinking about, okay, what's my trend filter? Is it above or below moving average? What's my entry trigger, the breakout or the dip or whatever it is? How wide's the stop loss? How wide's the profit target? How many days in the time stop? All of those sorts of things. Position sizing even, those are all kind of rules that are important to count. So we want to minimize that. Keep it as simple as possible. All systems should be as simple as possible. The next problem is over-optimization by cherry-picking parameter values. Okay, so we've got our rules. We've got 4 to 5 rules, right? When we optimize them, optimizing means we take the parameters, the input values, think like the 200 in the 200-day moving average, the 5 in the 5 ATR stop loss. These are parameters, right? And they're just numbers that we input. And we don't know what the best numbers are, the best numbers. So we're going to vary them. Like we might take our trend filter from a 100-day moving average to a 150-day moving average to a 200-day moving average to a 250-day moving average. And we might test all of those. We test all of those values by optimizing and seeing which is the best. And choosing the best value of a parameter in your optimization is actually one of the biggest problems in backtesting, because the best value is a cherry-picked value which performed extremely well in the past. And if we choose the very best value from the past, is the future likely to be that good or worse? Probably worse, because the very best parameter value in the past is probably going to be different to the very best parameter value in the future. So instead of choosing the best, what we want to do instead is choose the most stable. Again, let's go back to the moving average example. If we go from 100 and we optimize from 100 to 300 in steps of 20, so we go 120, 140, 160, all the way up to 300. And we look at the compound return, the returns of our system, right? We're going to get this curve and it's going to kind of look pretty jagged, and there might be a spike where the very best parameter value is, but either side of it, it falls away. And so we're going to look at this whole profile and we say, okay, I see that's the best one, the spike, but what I really want to know is where is the most stable area of performance. So we don't want to optimize for the best. We want to optimize to choose our parameter in the center of the most stable area of good performance, because the past and the future aren't exactly the same. So if we choose a parameter value which is stable, so it's if at 150 it works, and if at 125 it works, and if 175 it works, and they're all similar, it's nice and stable, It doesn't matter that the future is going to be different to the past because our parameter is pretty stable. We can push it up or down a bit and it doesn't matter. That's what we want. We want parameter values, inputs into our systems where the number doesn't matter that much. No matter where we put it, plus or minus a bit, it still works. That's a stable system, a robust system that's more likely to work in the future. If you just optimize every single rule in your system and you choose the very best value for each one, the backtest is going to look amazing. But in the future, it won't work because all you've done is cherry pick the very best combinations from the past. You're overfitting to the past data, and then the system will fall apart. That's what causes those beautiful sharp backtested equity curves to turn into volatile disasters in real-time trading. Okay, the fifth major pitfall of backtesting is failing to validate your testing. You've done your backtest, you've done your optimization, you've improved the system as much as you can. Now what you need to do is test it on some other data, some other markets, some data it hasn't seen to make sure that it still works, it still holds up. Because if you test, optimize, fine-tune your strategy over here, and then you apply it to a different set of data, maybe a different market, or maybe a different time period in the same market, and it falls apart and it loses money, what have you done over here? You've overfit it to the past data. But if you develop and optimize and fine-tune your strategy and you choose real stable parameter values, simple, robust rules that work over a broad range of market conditions, and you've done that well, when you apply that same system to unseen data, it should still be profitable. This is just like developing your system and then trading it in future unseen data. If the system doesn't work on old unseen data, it's not going to work on future unseen data, right? So again, we have to validate our backtest because there's always this risk that we're overfitting what we're doing, overfitting our rules to past behavior, past data, and it might fall apart in the future. Okay. What about fundamentals in backtest? Almost no one talks about them. Might be useful to include them. Yes, absolutely, if you can get them. It's getting easier too. It is now possible to backtest with fundamental data with certain online platforms. Portfolio 123 is an example. You can backtest with fundamental data in Portfolio 123. But 5 years ago, that sort of thing didn't really exist, certainly not at a sensible price for a retail trader. You don't need fundamentals to be profitable though. So I wouldn't let that be a barrier. It's much easier to backtest with technicals only, price and volume. And I've traded for 25 years using only technical-based systems, price and volume-based systems. So that definitely works. If you want to incorporate some fundamentals, you've just got to make sure that you've got all of the historical fundamentals and a platform that allows you to backtest it. So Portfolio 123 is one of those. I wouldn't start there though. If you haven't gone down the whole backtesting journey, I think I would start with a technical-based system, a simple trend following mean reversion based on price and volume movements, because you'll find it much easier to learn, and then go and apply your knowledge to backtesting with fundamentals. If I'm developing a system to trade in Australia, Australian stocks, all stocks on the Australian market, let's just say it's a long-term trend following system, I would take all of the tickers and I would randomly select 50% of the tickers and to develop my system on a random 50% and then validate it on the other 50%. I would also take a slice of time and test it on that slice of time and save another time period to validate on. I would also then take that strategy once I'd validated it on Australia and go apply it to Canada and the US and a couple of other markets and just check that it holds up. It doesn't have to work amazingly well on those other markets, but as long as it doesn't completely fall apart. Alrighty, key benefits I think we've covered. Determining that you've got an edge, determining that your rules are robust, monitor the stability of your edge, build confidence in your strategy, and prepare yourself to know what would happen in real life. So backtesting is not just about developing a system that's profitable. It's also about building confidence in that system and understanding what potentially could happen in your account. So if you haven't run a backtest, how deep could your drawdown be? You don't know. How many losses in a row could you get? You don't know. How long between equity highs? You don't know. How much could you lose in any one day trading? You don't know. But if you've backtested over 30 years of market history and you've really interrogated those results, you can answer all of those questions. And so you can build comfort. Say, oh, okay, I'm down 3 days in a row. Don't worry, totally normal. I've had 5 losses in a row, also normal. I'm in a 20% drawdown, also normal. It's been a month since I've had an equity high, also normal, right? All of the answers to those questions will depend on the strategy you're trading. But if you can't answer them, all of those situations start making us a little bit nervous, right? Have you ever been nervous when you've been taking a trade? Oh, should this be happening? Is it broken? Is my edge gone? Should I be in the markets or should I exit? All of those things are driven by nerves, fear, typically. And if you've done the backtest properly, then you can answer those questions about, is this normal? And if you know it's normal, then you can just keep following the system. If you know it's not normal, then something might be broken. You can do a deep dive investigation, figure out what's going wrong. And so that's also the benefit of backtesting, is really building that emotional confidence to keep following the system. How many of you have ever had some trading rules, but maybe hesitated to take a trade? Or maybe exited too early, or maybe not exited when you should have? Yeah, like most of us. And that comes from lack of confidence. Yeah. But once you've backtested thoroughly and you've got that confidence, it's much easier to just keep trading through the hard times because you know it's normal. Like you running the backtest, you can identify the bounds of what is likely to happen with that system. How many days down in a row? How many kind of winning days in a row? What percentage of winners? What percentage of losers? Depth of drawdown? All of those things you can answer. And when you know what to expect, it doesn't shock us when it happens. And that's part of the battle, right? We've got to stay in the game mentally. Be prepared for what could happen. How does backtesting improve our beliefs about trading? It's a little bit subtle. What do you believe about the market? If you really just sit and think for a moment, you've probably got some beliefs about the market. Oh, this happens. When you buy a stock, you should do this. When you buy a stock, you should have a stop loss. Yeah, some people say yes. Some people say what's a stop loss? Some people say, not always. Some people say, no, I never have a stop loss. So people have different beliefs. Now, I used to believe that you should always have a stop loss. That was a rock solid belief. I had an in-market stop on every single trade. But now that I can backtest properly, I can test that belief. All right, I've got a system. It has a stop loss. What happens if I take the stop loss out? What happens if I widen the stop? What happens if I narrow the stop? What happens if my stop isn't in market, it's next bar on open? And you can start to investigate your beliefs and see if they're actually true. And I've got a really great example of this. I have a system for Hong Kong stops. I've traded for a long time, many years. It's probably my favorite system, if not one of my favorite systems. Not that we should have favorites. We should be completely unemotional, but I am human, so I have favorites. Anyway, so this system had a in-market stop loss. I was like, Hong Kong market's really volatile. My stop keeps getting hit. And I feel like maybe I shouldn't have an in-market stop. I wonder if it's really true. And so instead of having an in-market stop, I backtested the same system with a next bar on open stop. Now, an in-market stop, what's the problem? The stop loss is here, the price is up here, but there's a sudden panic, the price dips down, hits your stop loss, you get out, and then the price does what? Boing, bounces straight back up. Now, the discretionary trader who lacks the discipline to follow the rules will say, see, I shouldn't have a stop loss. And so they stop putting a stop loss in the market. And then what happens? As soon as you do that, the market goes down and it keeps going down and it keeps going down. And you're like, oh crap, when should I get out? This loss is now too big to take. I'm panicking, right? Frozen, deer in the headlights. So from a discretionary trader's perspective, that's really bad financially. But systematically, I can test different types of exits. So I tested, instead of it getting out in market, I tested next bar on open. It gave a 40% improvement in expectancy just by making that one change, exiting next bar on open instead of exiting in market. Why? Because the market was so volatile that the long wicks kept hitting the stop loss but it was closing in that day and then opening next day way up from where the stop loss was. So the excess emotion, the fear in the markets intraday was causing the system losses that weren't necessary. As long as I had the discipline to exit the next bar at the open, if the stop was touched, I'll get out here, there was almost always a bounce. Not every time, but on average, over many trades, there was a bounce. And so on average, my average profit per trade went up, expectancy went up just by making that one change. And I would never have done it if I couldn't have backtested those two different rules and compared them. So my belief that every trade should have an in-market stop loss, I proved wrong. Now I have plenty of systems that don't have a stop loss or have an in-market stop loss or a next bar on open stop loss. I don't care as long as it's best for the system. You've probably got some other beliefs. So what I'd encourage you to do is think about, what are they? What beliefs do you have that you should do? And if you haven't tested those to validate they're actually true, maybe it's time to, just like the stop loss thing. What are some other beliefs? Only go long in a bull market, never go long in a bear market. Always have a risk return ratio of 2 to 1 or 3 to 1 or 4 to 1, whatever your belief is, right? Once you've got a certain amount of profit, move your stop up to break even so the profit can't turn into a loss. These are all beliefs that people have, and almost all of those are wrong in certain situations. They might be right in other situations, but they're not always right. And so here's the next lesson. In our trading, we need to revalidate our assumptions every time on every strategy in every market, because different markets behave differently. Different strategies behave differently. What you do with mean reversion is different to what you should do with trend following. All right, we've talked a lot about systems and rules and backtesting. If someone is new to trading or new to systematic trading, I probably just need to take a bit of a step back and give an example of a system or a trading strategy that you can backtest that has a positive edge. So I just want to give a real simple example. Think of trend following. Trend following means you follow the trend, right? If a stock is going up, you buy it, hold it while it keeps going up, and when it eventually starts going down, you sell it and you try and make money out of the middle. So a really simple trading strategy that generally works in a lot of stock markets is a trend following system where you enter on a breakout. So you buy if, say, today's close is the highest close in the last 200 days. You buy, and then you hold that, and you keep holding it no matter what it's doing until it falls 25% from its high or 20% from its high. So you enter on a breakout and you exit on a trailing stop. The price goes up and the stop loss trails up and up. And then when the price turns around and falls 20 or 25%, you get out. That structure is an objective system that you can backtest. Now you might need to add a few extra rules like a liquidity filter, like a volatility filter, like an initial stop loss. But in essence, that's a system that will give you a positive edge because stocks trend. And if you allow yourself to get in a stock that's trending and hold it while it continues to trend, you'll get big winners. And if you've got an initial stop loss that gets you out before you lose too much money on a losing trade, you'll have small losers, big winners, small losers, makes money. Make sense? So that's an example of a positive expectancy system. Now you have to backtest it for yourself. Different markets behave differently, and you might need some extra rules. But as I said, that's the general structure. Now, if you're going to backtest, what trading software do you need? How do you even do this? Depending on what type of system you're using, different trading software is required. I trade a lot of portfolio systems, which means one system holds many stocks. So 20 different stocks in the one portfolio controlled by a system. If you want to use systems like that, you need a portfolio backtesting software. Amy Broker, Realtest, Multicharts, Wealth Lab all do that. If you have a single instrument system, like this set of rules applies to this ticker. Let's say you're trading the SPY and you have rules that trade the SPY in and out, and it only trades the SPY. You can backtest that on Metastock, MT5, MT4, TradingView, although TradingView backtest is a bit ugly, but anyway. You can also backtest single instrument systems on portfolio software like Amy Broker, Wealth Lab, Realtest, etc. So I really prefer portfolio backtesting software because it gives you so much more flexibility. The one that I really like at the moment the most is Real Test because it's just so powerful, super easy to code, and works really fast. I have used Amy Broker for many years. I've also used multi-charts. I've also used Wealth Lab. That's the kind of software you need. It will cost you a few $100 depending on which software you want to buy. You also need the data, so you need a historical data subscription. I use two data sources. So I use Norgate for the Australia, US, and Canadian stocks, and I use Metastock for everything else. Get a good quality data source because having good quality data is really critical. You don't want to use free data for backtesting because you get what you pay for, and the data won't be adjusted for stock splits. It won't be error corrected, and you won't have any dividend adjustment, and basically it'll just be mayhem. You'll get erroneous results. So use good quality data. Norgate is my first choice, absolutely, for Australia, US, and Canada. For anything else, you need to use Metastock. The good thing about Metastock is it has one data subscription that gives you every stock market globally. So for, I think it's $40-50 a month, you can get access to the data for every single stock, and that means you've got a lot of data for backtesting and validation on. Okay. What else? Let's get into some more advanced stuff. How many trades do I need in my backtest to get reliable results? To have confidence in my results? What do you think? What number would you say? The answer is it depends. It depends on a few things. It depends on how complicated the system is, how many rules the system's got. So the more rules you have in your system, the more data you need to validate those rules. Because if you add lots and lots of rules and you only have a very small number of data points being a trade, an entry and an exit, if you have 10 different rules in your system and only 50 trades in your backtest, there's a very high chance that you've overfit your system to those 50 trades in your backtest. But if you've got 10 rules in your system and 5,000 trades in your backtest, you've got a much better chance of having a valid system and not overfitting to the past data. You can still do it, but it's harder to overfit. So the more complex the system is, the more rules you have, the exponentially more trades you need in your backtest to validate it. So in order to keep it reasonable, keep your system as simple as possible. 4, 5, 6 rules, if possible, will allow you to have 500 to 1,000 trades, and you can probably validate your strategy. And if you're thinking, wow, 500 to 1,000 trades, that's a lot. Chances are you've probably been backtesting manually on the charts. When you get into automated backtesting, it's no problem to generate 500,000, 5,000 trades with the backtest because the computer does it in the blink of an eye. So we get a lot more data to validate our trading strategies. Making sense? So I go into a lot of depth in how to validate the trading strategies, how to check that you don't have too much complexity, how to check that you haven't overfit. I go into a lot of detail in all of this in the Trader Success System, which is my kind of flagship program. So this is scratching the surface really on how you do all this, but I really just wanted to make sure to raise some of these issues to your awareness so that you can at least start to learn about some of this stuff. All right, the next question closely related about validating your trading strategy. It is, what is a good method for choosing your in-sample and your out-of-sample data to validate, or to build and to validate your system on? How do you choose what is in-sample and what's out-of-sample? Now, let me just clarify. In-sample data is the data that you develop, test, optimize your strategy on. Out-of-sample data is unseen data that you use at the end of the entire process to check whether the rules you've developed over here work on unseen data. Okay, in-sample, out-of-sample. There's several different ways to do this. The biggest driver of success is having an in-sample data window that includes all different types of market behavior. Bull markets, sideways markets, bear markets, and preferably a couple of cycles so that you're not just overfitting to one particular cycle. You want to go through several cycles. And that way, you're developing and optimizing over the whole market cycle so you know how bad it gets in the bad times, how good it gets in the good times, and you make sensible trade-offs. If you only develop and optimize your system on bull market data, it's going to look amazing for bull market data. But when it gets to bear market, it's probably going to fall apart. So for in-sample, you want several bull, sideways, bear market cycles. And then for out-of-sample, preferably at least one of each cycle at least. And if you can't get that in one market, then make sure you go to another market to validate. That's how I think about it. You also want to make sure you get enough trades. So if you have an in-sample window and you develop and optimize your system and it's a quite complex system, let's say 6 or 8 rules, and you've only got 50 trades, you don't have enough data. So you need to use more data or make your rules looser so more trades come in, so you're not overfitting to a small number of trades, and then validate it on other data. Now, following from this, what are my thoughts on walk-forward optimization? Walk-forward optimization, pioneered by Robert Pardo, is held up as the gold standard in backtesting. And look, I say gold standard because that's what people say, right? And it is. It's the most rigorous way to test. Walk-forward optimization is where you have your system rules and you test them over, let's say, a year of data, and then you find the best parameter combination, and then you walk it forward 6 months on unseen data, and you see how it performs. And then you optimize it again on the next set of data, and you walk it forward another 6 months and see how it performed on the unseen data. And then you optimize it again, and then you walk it forward. And then you optimize it again, and then you walk it forward. And you're basically stringing together these out of sample walk forward periods to develop the whole backtest equity curve and all of the performance stats. So it's quite rigorous in that you're not kind of overfitting and choosing the very best values and then saying, oh, look how nice and smooth my equity curve is. It gives you the ugly equity curves, the out of sample equity curves for you to make your decisions on. So it's quite good in that respect. However, there's a problem. It only works well for certain types of trading systems. If you have a very short-term trading system, let's say a mean reversion system, and the trades are pretty highly uniform, and you have many trades at each period in the backtest, walk-forward can work really well because you get enough data in that small optimization window to get a good optimization value to test in and out of sample, and the optimization works. But if you've got a trend following system and it trades only a few times a year, you've got a much smaller number of trades, and the trades are long and they're irregular. There's a small number of really big ones and there's a lot of really small losses. It's really hard for walk-forward optimization to generate sensible parameter values. So it just doesn't work well for trend following systems. So I use it for very short-term stuff. I don't use it at all for trend following stuff. How many of you struggle to get good ideas to test? Good ideas for systems? So I got a question here. How do I come up with ideas to test? And I do get this a lot. And there's several different ways I use to generate ideas to develop systems and test systems on. The first one is I keep a journal. I have a journal. Actually, I keep several different styles of journal, if you like. One of them is an idea log. So whenever I'm reading a magazine, that one's not open yet, or reading a book, or just thinking about trading, I'll dream up ideas and I'll keep a journal of them in my phone. I have a OneNote notebook in my phone, which is just trading system ideas. And so I just capture the ideas whenever they appear to me, whenever they occur to me. And they come from several different sources. One of them is just looking at charts. I spend a lot of time looking at charts and just saying, okay, how is price moving? And what are the stocks doing? And what's the broader market doing? And that's really helpful because that will stimulate ideas. I'll look at different indicators on the charts and just see how they behave and what sort of moves they catch. And again, I'll use that as a brainstorming tool. I document everything. So I do a lot of journal writing. If I'm playing with one system, I'll write down what I tested. That will usually spark other ideas. My students send me a lot of systems, so I use that as idea generation as well. I look at what they've done. That sparks some creativity. I come up with some new ideas. I send the ideas back to them. I write the ideas in my journal. I read books, read magazines, read trading blogs, and I ask a lot of what-if questions. Okay, what if this system was shorter term? What if this system didn't have a stop loss? What if I could get in earlier in the trend? What if I could get out before the trend turned? What if I do a lot of that to think about variations in what I'm already doing? And a variation of a system is as good as a brand new system because it gives you diversification. So there's some of the main sources. I don't buy many systems from other people now, mostly because I can develop it well myself. But in the past, I've bought quite a few systems as well. And in the Trader Success system, I provide more than 20 different strategies, mostly because most people don't have their ideas at the beginning of the journey. So they need ideas to get them started. So I have complete systems for people to get started with. So that's how I come up with ideas that are worth testing. How do you know after you've backtested a system, is it good enough? to go live? This is probably one of the harder questions in trading to answer. And the reason it's hard is because we always have this temptation to just make it a little better, just work on a little more, just optimize it, just get it a little bit better. I just want the equity curve to be a bit smoother. I just want to reduce that draw. I just want a slightly higher return, right? This is a never-ending challenge of perfectionism. And the trouble is, perfectionism in backtesting, where you keep going and going, trying to improve it, trying to improve it, trying to improve it, actually ends up doing the opposite. Because the more we optimize and the more we try and improve our strategies, the more overfit we end up being to past data, the worse they perform in real life. So I have a process for backtesting. And again, I'm not going to go into the whole process here. It's proprietary. It's what I teach all my students in the mentoring program, but it's a once through process. You get the system, you follow the steps. One of those steps is optimization. We optimize once. Go through each parameter, optimize them once. We brainstorm for improvement ideas once. We test those improvement ideas once. And when you get to the end of the process, you validate that the system passes or fails out of sample, and you make a go or no-go decision. The process is linear. And if you get through the process, at the end, you make a decision, did it pass? In sample, out of sample. What that means is, did it hold up on unseen data? Now, passing doesn't mean it's great. It doesn't mean it's going to make 30% return per year with 5% drawdown. It doesn't mean any of that. It just means you develop the system on your in-sample data, and when you validate it on out-of-sample data, the performance was similar enough that you can pass it. That's the first stage gate. Okay, this system held up. Great. Should I trade it? It's a completely different question. It's unrelated to backtesting. And this is why it trips people up so much. The decision to trade a system is nothing to do with the backtesting process. It's everything to do with capital allocation. So if you've got a strategy already and you're trading it, and you develop a new strategy and it passes your out-of-sample test and you get to the go, no-go decision, your job is not to say, is this system good enough to trade? That's wrong. Instead, what you want to do is say, if I add this system to my portfolio, does it make my portfolio better? It's a totally different question. Can you see how it's different? Because you might have a really great smooth equity curve, but it's so highly correlated to what you're already doing that it doesn't add any value to your portfolio. But you might have a really ugly equity curve that doesn't make much money, but it makes money exactly when your other system loses money. And when you combine it into the portfolio, it smooths things out. So your portfolio level return goes up. Then you can say, this system is good enough to trade and allocate money to. Now, this is the nuance. The people who think at the system level get trapped in this never-ending cycle of optimize, improve, and improve, and can I make it better, and how much return can I get out of this system? But we don't care about each system. We care about the portfolio of systems, because we're never going to trade just one system. We need several working together in a portfolio. So once you develop a system that passes, if it adds value at the portfolio level and improves your returns, then it's good enough to trade. Does that make sense? It's a totally different mindset. And it really frees you up because you're not agonizing over generating a system that has certain stats. You've just got to get a system that passes the out-of-sample tests. All of those tests in the process. If it passes all of that, then you do capital allocation. So freeing. It means you can get through the process much more quickly, build your portfolio more quickly. And a portfolio of good systems is way better than one great system because you get good diversification. How many of you have had that experience where you've tried to develop a system and then it just falls apart, it doesn't pass, and you have to throw it away? Yeah? I need to let you know that's completely normal. Developing systems that work and hold up in the future is hard. And you throw away a lot. I liken it to trend following, in fact. In trend following, Most of your money is made by a very small number of trades, the very big winners. And you have to take a lot of small losses to get to the big winners that make the money. System development is similar. You have to test a lot of ideas that you throw away after a couple of days or a couple of weeks to find the one system that works that will end up making you the money. The trick is to throw them away more quickly. So if you're testing the strategy and you're torturing it for weeks, trying to make it work, there's one more filter, let me try one. Oh, I had this great idea, I'll try this one more thing. Let me just do that. Oh, no, I'll just optimize it again and I'll add another filter. I'll just try again and again. You're going to waste weeks or months. And I know because I've done it. So you're not alone. It's completely normal. But the trick is to have a once through process that you can get done more quickly, so you can throw away the bad ideas more quickly, so you can test more ideas, so you can find the good ones. That's the trick. So I throw away ideas way more quickly now than I ever used to. In fact, for my mentoring program, I did a live demonstration. The entire backtesting process, end to end, all the optimization, all the brainstorming, all the testing to filter ideas, all the validation, all the robustness testing, everything, 90 minutes. 90 minutes end to end. If you can do it more quickly, you can test more ideas, then you can get on and find the good ones. So you are going to throw away a lot of ideas, and that's okay. That's normal. But most of us don't like to be wrong. We don't like to waste our time. But think of it as panning for gold. You get the kind of sand and the rocks and you swish it around in your pan with the water, and the sand and the rocks and the dirt goes off the edge. And if you're lucky, you're left with a couple of specks of gold in the bottom of the pan because the gold's heavy and it sinks to the bottom. You've got to sift through a lot of crap to get the thing that's valuable. Same thing with trading system ideas. You've got to be willing to sift through a lot of crap, throw away a lot of ideas, hopefully more quickly, so you can get to the good ones that are going to make you a fortune. A good trading system can be worth hundreds of thousands or millions of dollars. I've had a single trading system make me very high six figures, close to seven figures. One system, one set of rules. And so would you be willing to throw away 20 bad systems or 50 bad systems to get to one that works? I would, right? That was worthwhile. So the trick is do it more quickly. How do we decide what system to trade in each type of market or at any one point in time? That's the broader question, which is really important. And the answer is probably not what you expect. What you want to do is look at each system and say, all right, when can this system make money? And when does it not make money or not make money reliably? And each system should have rules that turn itself on or off depending on the market conditions. As an example, trend following, small cap stocks is generally best done in a bull market, right? So generally it's better if you're trading trend following in small cap stocks. You want to only trade it when the broader market index is going up. You're going to make a lot more money. If it's a bear market and the index is going down, you're probably not going to make a lot of money, if any, trend following small cap stocks. So turn that system off. But that switch on and off is a rule in the system. We're not deciding anything. The system has a rule that turns itself on and off. That should be part of your 4 to 6 rules. And a mean reversion system, similarly, it's going to work better in a volatile market and less good in a really low volatility smooth market. Generally speaking, there are exceptions, right? But there will be conditions when it works well and where it doesn't work well. And that system should turn itself on and off. So I'm not deciding, you're not deciding when to turn a system on or off. The system turns itself on and off because it's got the rules to do. And instead of switching our money in a discretionary way from one type of strategy to another, we allocate capital to our systems. Let's put 10% to system A, 5% to system B, 15% to system C, 10% to system D. And if that system is in the market, that capital gets used. If the system is switched off, that capital sits in cash or gets used by another system. So rather than manually switching systems on or off, you let the system do the work and the capital allocation do the work. So the system turning itself on and off and the capital allocation between all your different strategies work really nicely together to best allocate your capital without us having to make a conscious decision. As soon as we start making subjective decisions about turning the system off, turning the system on, we've lost the game. Because that's going to become emotional and it ruins the whole point of systematic trading. Hey, I want to do one thing before I forget. Let me do this. If you're really loving this and you want to talk about next steps for you, okay, I do obviously have programs and mentoring and courses and everything. If you want to talk to me about that, click that link in the chat. A couple of questions to answer, and then you can schedule a time with me. So click that link and hopefully I'll see you on my calendar in the next few days. Alrighty, let's do some more advanced questions. How do I know when to stop optimizing my trading system? When is it enough? Most people will optimize and then change something and then optimize again and then change something else and add another filter and then optimize again. And there's this kind of looping kind of process that feels never ending and actually is never ending. It's a perfectionism that actually won't help your trading. My process for backtesting and developing systems is a once through process. Brainstorm the rules, code them up, test them and optimize, add filters, or brainstorm ideas to improve that core system. Then significance, robustness out of sample testing, just once through. I have certain stages that I go through. And optimization only happens one time. So I'm not looping and re-optimizing, it's once. So when you have that linear process, you don't have to make a decision about when to stop. You just do each step in the process. And if you don't have a backtesting process, then we should talk because you need one. Because if you do it the same way every time, it gets faster, you get better at it, you make better decisions, you'll be able to eliminate or reject the bad ideas more quickly so you can get onto the good ones. Having a solid backtesting process really accelerates your trading journey. It's one of the most powerful tools for a systematic trader. Once you know how to backtest, get a process that is the same each time. It's like a pilot's checklist. When a pilot gets on the plane, they don't just go, oh, should I check the fuel gauge today? And look, the wings are nice and clean. And oh, that engine hasn't started. They don't do that. They have a pre-flight checklist and they check everything. Why do they check everything? Because if they don't, people die. If you don't backtest the same way with a checklist each time, guess what? People don't die, but your account's going to get hurt. So having that process will tell you when to stop. It'll shorten the process, allow you to get in more cycles, more testing idea cycles, which will get you the good ideas more quickly. So hopefully that helps. How do I know if my system is degraded? And how do I know if it's degraded to the point that I should turn it off? This is really important because unfortunately, and you might not want to hear this, but unfortunately, no system lasts forever. Right? Edges do decay. Short-term systems, very high-frequency systems, tend to decay more quickly than longer-term systems, but all systems can decay over time. So you have to monitor their performance. And the way I monitor performance is I run the backtest on a regular basis and I look at how the equity curve is performing. That's one thing. I also look at the underlying statistics of the system over time. I monitor the win rate. I monitor the size of the wins. I monitor the size of the losses. I monitor the average profit per trade and see how they're trending. If all of the stats are starting to trend down in the wrong direction and they start to move outside of the range of what's historically normal, then you know you've got a problem. So I have tools and templates to monitor this. You basically take the backtest, you put it into the tool and you can see, all right, is it degraded or is it okay? Is the current performance normal or not? And so you want to know, basically answer the question, is this performance measure within the range of what's historically normal for this system? If it is, great. Okay, the system's going through a rough patch, but it's normal because performance comes and goes, right? But if the performance statistic is starting to trend outside of the historically normal range, is getting worse and worse, then you know you've got a problem and chances are the edge is decayed and it's time to really do a deep dive and look into that system or maybe turn it off. And I think a lot of people don't monitor their strategies close enough and so leave them keep on trading beyond when they should. And go, oh, wow, that's a deep drawdown. Maybe I should turn the system off. Often it's too late. It's not too late. You should still turn it off at that point, but often they've left it too later than they should have. So monitor your systems closely. I backtest all my strategies every week, and then I do a deep dive every couple of months to check all of the performance stats and make sure they're all within range. And what I've developed is a tool, the system monitoring spreadsheet, where I have this great process where I run all of my systems one after another automatically. All of their results get sucked into an analysis spreadsheet. That spreadsheet analyzes the equity curve and the performance stats and tells me which ones are flashing warning signs based on how they're behaving recently compared to historical behavior. And this is something all my students get so that they can quickly assess, should I be worried about this system or not? And you need a process like that, because by the time you've got a couple of strategies, you then need to start monitoring them to make sure that they're still performing. This becomes really important to make sure you know when to switch a system off. How do I prevent overfitting while still making the system better? Now, this is a really great question, because you can overfit in so many ways and all of them are bad, but you can still improve your system in a good way. So how do we do it? The first thing is have a backtesting process like I talked about earlier. What are the steps you follow in order, in sequence, to backtest your system correctly? Do it the same way every time. When you're trying to improve your system, the best way to do it is not by optimizing, not by varying the parameters and trying to find better parameter combinations. So don't try and improve your system just by optimizing. Instead, think, all right, step back and look at the rules and say, what is it missing? What market behavior could hurt this system? What market behavior could this system benefit from that it's not currently catching? What type of conditions generate bigger returns or smaller returns for this strategy? What market conditions are my worst losses in or my best gains? And try and think about some filters or some, like a regime filter, that might turn it on or off at a smarter moment to better capture the edge. Or try and think about a different type of data to help you refine. If you've got 3 moving averages and a MACD and a rate of change and you throw a Bollinger Band at it, it's not going to help, because all of those things are basically measuring the same thing. So instead, think of what other types of data can I get? Maybe it's volatility. Maybe it's relative strength. This versus the market, this versus other stocks. Maybe it's candlestick patterns. Maybe it's volume. Basically, you're looking for other types of data. Maybe it's the performance of the index, the performance of the currency of the market you're trading, the performance of gold or the underlying commodity of that the companies are using. Think about other types of data that you can incorporate. Because the more you use the same indicators on open, high, low, close, the more you're just overfitting to exactly what happened in the past. You want to have different angles to try and improve your system. I don't want too many rules that use the same data in my system, because all it is overfitting. Instead, try and bring some diversity into the system decision making, and you'll find that you'll get much better results, more robust rules. Okay, that was a lot. I hope you've enjoyed this free Q&A session covering everything you need to know about backtesting. If you want to go further and you want to learn how to develop, backtest, and implement portfolios of your own trading systems, then click the link in the description and find out more about the Trader Success System. All you have to do is enter a couple of questions. Then you'll be able to schedule a time with me so that we can talk about whether or not you're a good fit for the Trader Success System and how I can help you achieve your trading goals in the next 6 months. So click the link in the description. I'll see you in the next couple of days. Bye for now.